So I was looking for a house a few, probably 4, 5, 6 years ago, and I remember thinking to myself, I want to understand every aspect of the home buying process, and I don't know why. Where does interest rates come in? How do interest rates impact my home buying experience and home owning experience? And if I could tell you what I would have told myself if I had known everything that I know now, I would have summed it up in this video, I guess. I would have told myself, spoiler alert, yes, interest rates, they impact a lot in the home buying process. They affect both how much you can afford and they affect how much it's going to cost you to continually own and operate the house. And then I would show myself this. Let's just look at this house here in Arizona, Glendale, Peoria. It is a $475,000 house, very nice, probably relatively new build. Ooh, some upgrades. Typical 1-story, 3-bed, 2-bath, and has an HOA of $50 a month, and property taxes $156. So I would take this, for example, and just enter it in here. So we have $475 for the home price. We have, let's say I put down 5% down payment. Let's enter the HOA first. It was $50. Taxes was $156, I think, times 12. We'll leave utilities out of it. Monthly repairs, let's call it $100 a month, and improvements $100 a month. Let's say I have great credit, which I did at the time, and I still do. And let's assume that we're going to use a conventional mortgage to buy this home, which is different than an FHA. I'm not going to explain that right now, and then let's say we can turn around and rent this home out for $2,500. I don't know the Arizona real estate market very well, but it seems like a home that you could probably rent out for that much. Now let's assume the interest rate is what it was at the time that I was looking to buy my first house. The interest rate was about 4%. So here is our little income statement. The scorecard here illustrates, I'll zoom out a little bit, it illustrates how much it's going to cost to basically own the house and how much it's going to cost, how much our net gain or loss is going to be. I forgot to enter a monthly insurance fee. Let's call it $70 a month. Okay, so cost to own. Principal per month would be $662, interest about $1,500, property taxes $160, home insurance $70, mortgage insurance, because I'm putting down less than 20%, I have mortgage insurance which protects not me, but the lender if I default on my loan. But that goes away after I achieve between 20 and 22% equity. HOA 50, repairs and improvements. So total expenses, total rents, I would not be breaking even within the first year if I decided to turn around and rent it out. In fact, I would be at a loss of about $3,000 in the first year. Well, let's fast forward to the house that I actually did end up buying. Let's assume that it's this house in Arizona, but let's put the interest rate that I was able to lock in at a 30-year. And let's just remember this 2,700 number. We'll just copy these two, whoops, numbers, values only. Special values only. Okay. So 2,700, 1,492. So now what I'm going to do is I'm going to change this interest rate to 2.875, and let's see how that impacts things. Okay, wow, suddenly our interest went down from almost $1,500 a month to almost $1,100 a month, which is a decrease of about $300, actually over $300. And our overall expenses went down by that much as well, down to the point that we're actually profitable. Barely, but profit is profit, right? That is crazy. Okay. That changes things because now my monthly payment is $24.61 instead of $27.43. I'll tell you what, I definitely would not have been able to afford $27.43 back in the day, nor the $24.61 actually. So I think my debt to income ratio only allowed me to have about a $2,000 mortgage, which still a lot more than I wanted, but man, things have changed. Now, for fun, let's put in today's interest rate and see how that changes things. Let me just paste that in there, and we will paste this in here. So, let's see how today's interest rate changes things. Driving down the freeway today, I saw that the interest rate was 6.885. Wow, look at that big negative $1,000 monthly loss. That is crazy, driven of course by interest. So the interest rate went from $1,492 at 4% down to $1,071 at 2.875%. Now up at these interest rates at 6.89% interest rate up to $2,600. What does that mean? Well, that means that if I had this interest rate, I would be paying 2.5 times the amount of interest that I am now on the property that I bought, ended up buying about 4 years ago. That is crazy. And that is driving the huge, almost, $1,600, actually more than $1,600 difference. Wow. So let's just put that back at 2.875 because I get anxiety just looking at that. Now switching back. Switching back. Okay. So let's look at now how this affects our long-term wealth building prospects. So let's start with it at the 6.89. So at 6.89, our principal pay down is always going to be the same. Our price appreciation is always going to be the same. Really what's going to be the biggest difference is our cash in/out. And in this case, we will end up making a profit eventually interest rates at 6.89%. Let's see how long it takes. So we see the first year net income is negative almost $13,000. Yikes, that hurts. 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. 12 years. 12th year we're profitable. In the meantime, we are spending almost $82,000 out of our own pocket just to cover the difference between the rents and the expenses. Yikes. And then we see in the 12th year we make $729. Congrats. And if we were to invest that for 18 years, that would eventually be $4,053 at 10% interest rate, invested in the stock market, which is what we assume we'll do every year that we make a profit. We'll throw that straight into the stock market and it'll turn into something greater than it is, except for the last year, in which case it's not going to have a chance to any time in the stock market to make any interest. So back up here, let's delete some of this stuff. At 6.89%, our house created net worth, which is adding up each of these three pieces here: principal pay down, price appreciation, net cash in / out. We are at 1.9 million. I'll just write that here. At 4% interest, which is when I started looking for houses, our house created net worth, again these first two pieces being the same, is going to be 2.4 million. At 2.875%, our house created net worth is going to be 2.7 million. So each basis point that interest rates go up really takes as long as you're waiting to buy, still takes a serious toll on the amount of the cost to own the property, and B, the net worth that it will end up generating for you throughout time. Now, there's always the hope that you can refinance at some future date, but that's not something you want to buy a house counting on. You want to be able to buy the house knowing that worst case scenario, interest rates stay exactly where they're at or even get worse, but you have a fixed 30-year interest rate and your principal and interest payment are not going anywhere. Wow, that is, between the lowest interest rate and the highest interest rate, that is a $800,000 difference in net worth by the end of the 30 years. That's absolutely crazy. Well, younger self, now you know what to do. Go for the lowest interest rate. I wouldn't buy down the interest rate because you never know how long you're going to own a house. But make sure that it makes sense at whatever the market interest rate is. Make sure that your profit margins make sense. Again, a gain is better than a loss. That being said, yes, I have bought a house thinking that I would be able to rent it out and probably lose money by the end of the year. Luckily, that did not happen. But just keep these things in mind. And I want to just exhort you to not plan to refinance when interest rates drop. Yes, if they do, and you can refinance, then do. But remember, your income situation is probably going to change. Remember that interest rates aren't going to always do what you think they will. In fact, I remember 2 years ago when interest rates were skyrocketing. I'm talking from 2025, and we're in January here. And I remember January 2023, interest rates just spent the last year going up. And everyone said, oh, this is going to be temporary. And then guess what? People started, you had mortgage lenders and especially new build lenders that were saying, here, buy this 210 or 321 I'm not going to get into what those are, or buy this right now knowing that you're going to be able to refinance in 2 years. So if you can suck it up for 2 years, then this makes sense for you, as long as you can afford the current mortgage payment or get approved for it, not even necessarily afford it. And guess what happened? I'll change so that you're looking straight at me. Guess what happened? Even though the federal government said this is temporary, even though every professional, every expert said this is just a temporary hike in rates so that we can get inflation under control, that's not what happened. And now you have a lot of people that are locked into a mortgage thinking that they'd be able to refinance now, and interest rates are at or even higher than they were back then. And those people, what are they going to do? Sell their home? Guess what happened to home prices? Guess what happens to home prices when interest rates go up? Well, luckily, they've continued to go up, but in some pockets of the states, interest rates going up has caused their home prices to go down. So if those people bought a house 2 years ago thinking that interest rates were going to go down and they'd be able to refinance, well, guess what? Now they can't even sell their home for a profit. Let that be a warning. Hopefully I've covered everything as in-depth as you were looking for. Let me know in the comments if you have any questions. I'll be happy to go over anything again or go more into detail. Thanks for joining me today. Have a wonderful day.